Ever wonder who actually decides the mortgage rates? Well, we're going to talk about that on this week's Wisdom Wednesday. What changes your rate? Well, your rate can shift based on many things. Primary home versus rental property, shorter long term versus longer term, how much money you put down, and credit score. All totally normal, and every lender uses these. Well, why do rates look pretty much the same everywhere? Well, all lenders look at the same thing when setting their rates. It's not the treasury bonds. It's something called mortgage-backed security, aka MBS. How does MBS affect the rates? Well, think of it like a seesaw. When MBS rates go up, mortgage rates go down. When MBS prices go down, mortgage rates go up. Well, what makes the MBS prices move? Well, there's two major drivers there. The economy. Strong economy equals investors move money to the stock market, which means less demand for the MBS and higher rates. Inflation. Rising prices. Fed tries to cool things off. Rate hikes. Well, MBS prices go up when investors get nervous about the economy or markets and move their money into safer bonds, which in turn lower the rates. MBS prices are relatively stable at the moment, and with Treasury yields trickling up slightly, it implies mortgage rates aren't likely to drop dramatically immediately, but they're holding. If you have a friend that is waiting on these rates to drop, send in this video to explain what the holdup is. Thank you so much for tuning in for this week's Wisdom Wednesdays with Withers. Tune in next time.